The guy's just constantly talking. Yeah, all right. I'm gonna narrate. Eric comes out of the bathroom. He was listening in there, so it must have gone well. Little shake there, and he's back to work. I love it. Hey, welcome to the Closing Beat, everybody. Happy Thursday. How you doing out there? All is good. Whoa, looks good. Looks good. Welcome, Matt, Missy, Craig, Mr. Bishop. How you doing today? Welcome back. Hey, sorry about yesterday. That will be one of the last times that I end up having to miss the show. Just had a few things going on and opportunity. What?
One of the last times ever?
One of the last times that I'll be missing the show for a while. Yeah.
Oh, for a while. Okay.
Yeah. Everybody's giving me grief in here.
Okay.
Yeah, I just, I take care of some things, It's called a personal day. And got it taken care of. So I'm back, happy to be here. We are financial advisors here at Jazz Wealth. Hope you're happy to see us as well. We're going to talk about the stock market here today. Don't have a whole lot for you because it's a really interesting area where the stock market's at. And please keep in mind that the goal of the show for me each day is just for you to see this. That's genuinely the selfish reason that I'm here. But I like to talk about the market at that moment in time. And so that doesn't mean that we are moment in time type traders or that's the service that we offer. We're very much long-term investors and like to focus on retirement, those long-term goals, the efficiencies of using your dollars, general financial advisor type stuff with a whole lot of extra goodness. And so just keep in mind, I don't mean to come across as a short-term investor, trader, or anything like that. It's just kind of cool to see where the market's at. And like I mentioned, really cool spot where the market's at because your odds of success are really low right now. So I want to point that out as we go through that. Hey, our Wine and Wealth class tonight, it'll be live. It'll be with me. It'll be here. Grab a drink. Come hang out with me if you're one of our clients. I think I'll go with the wine tonight after the week I've had. And we're going to talk about the Secure Act strategies. So I'll review them. I've got actually a great little takeaway for you where we're going to say, well, what's available to you? And what do you do with that? So what's the underlying, like, what are the rich people doing? You get a new law and then you find out 10 years from now, this is how they took advantage of it. We're going to go through that there. I've got a couple good ones for you. And then we'll cover some other stuff as well. So hope you're ready to hang out with us here tonight. Let's take a look at the S&P here to start the day. Ta-da, moving over. So blue line on the charts, very much a downtrend. If you do not like technical analysis, for the moment, you're in the odd camp, right? It's a little bit odd for you to not respect the downtrend. And I say that because it is very clear at every point that we are looking at this downtrend. I've been pointing it out, how it gets rejected and, it's just not great. But it is very clear that the market understands that that's an area, a ceiling, a little overhead resistance, if you want to sound fancy. And so that's where we're pulling back off of here. Now, despite this sell-off so far of what we've had, we're still positive year to date. Well, at least the S&P is. So up 1.5% for the S&P. That's a little more realistic. The average gain in the first 100 days for the stock market is 3%. So a little wiggling around to get us there is fine. If you didn't know that, there's your first stat of the day. Yesterday I saw it was labeled as a risk-off type of day. Okay, that's a way to say it, but no respect for the 200-day moving average. No respect for the downtrend there, which is clearly what everybody's using. And so very, very cool there. If you like it or not, technical analysis is driving the stock market because we don't have much else to go on. We have very limited market-moving economic data coming out, or that has come out. Earnings season is kind of ramping up. We'll cover that here in a second. Plus, there's a bit of a gotcha in this earnings season, so not going to be as exciting as maybe others there. And remember, technical analysis is not a godsend. It is not a crystal ball. It is telling you when you might want to participate in the market, right? Fundamental analysis tells you why you might want to participate in a stock, in an ETF, in the market. And technical analysis tells you, well, hey, I like this stock, but it's a little overvalued, overpriced right now. Maybe I'll just let it take a break. Or it's at a known resistance area. It's at a downtrend area. So something very much to pay attention to if you like that sort of thing. And if you don't, it never hurts to learn a little bit. Hey, I'll tell you what. In a little bit, I'll actually go through a couple sectors and I'll show stocks that are at important technical areas there. I hope, because I just spoke out loud before thinking. So, that happens too. The NASDAQ, let's take a look over here for the day. The NASDAQ is in second place as far as best performers. It's up 3.25% for the year, despite the pullback here, so we're cool with that. The Dow, unfortunately, has gone negative, yes. It's down about 1/3% for the year. Interestingly, in the first 100 days of the stock market, the Dow is the underperformer. Right? So the S&P average performance is right at 3% in the first 100 days. We're nowhere near that. I'm just getting ahead of us here. But the Dow is the underperformer, and so everything right now performing as expected for the Dow, even though maybe not in the direction you'd prefer. If we look at crude oil, a couple interesting things relating to both the market and the economy here. So crude oil, yesterday it breaks this streak, well, 1, 2, 3, 4, 5, 6 days up there. And it's also trying to break this downtrend, which, by the way, there's a lot of stocks doing that out there. There's a lot of commodities doing that. There's a lot of ETFs doing that, which, of course, are made up of stocks and commodities. So anyways, trying to break this downtrend, however, is very difficult to go counter trend on oil. I've mentioned that numerous times. So that's interesting that crude oil is sort of struggling here. Let me add to that bonds. Can you see that? Yeah. So bonds coming off of really 4-month lows here. That's a 4-month high, I should say, for bond prices, 4-month lows for your interest rates. Well, that's a good sign there. That really helps your target date funds as well. They sort of got smacked last year. Here's the trouble. Normally, oil is higher and bonds are lower, yields, I should say, sorry, bond yields are lower when investors want to position for a recession. You say, okay, no problem. I got higher oil prices. I don't have that right now. Yesterday, we had oil prices moving lower. I have lower bonds, bonds in general lower. Okay, I don't really have that, kind of got that going on there. But if it were 100% true that everybody's positioning for this recession, which is all I keep hearing about here, then you'd have other areas showing some excitement as well. Let's take a look here. So you'd have consumer staples. Well, they're falling apart. Normally, consumer staples do really well ahead of recession or when people start kind of getting that fear of a recession. We just don't have that. Utilities, there we go. They tend to perform well, falling off a cliff here in the short term. So to say that investors are actively positioning for a recession, I don't know how they're doing it. They're not doing it in the traditional sense there. Also, I'm going to point out just a broad overview here. Looking at tech. Tech was one of the better performers yesterday and has been. Even though yesterday every sector was down, today almost the same thing, tech was one of the better performing areas. That shouldn't be true if we're going into recession. Communication services, that was also one of the better performing areas, even though it was down. Well, that shouldn't be true either. Today was the second best performing sector. So you see how I'm painting that picture where everybody's saying like, oh my God, I got to do stuff to get ready for a recession. At the moment, you're kind of on your own. The broad participation in the market's just not seeing that there. So it's an interesting one. Now, looking at the S&P, why did I say a minute ago your odds are lower at getting an entry point or a starting investing point right? Well, it's because we just hit a resistance area. So the market's really predictable at extremes, and that's not my analysis. That is sort of widely known there. A market that is an extremely overbought area, it's very predictable, give or take a little bit, to actually bet on a pullback. A market that has fallen off a cliff, like we saw at the beginning of last year, like we saw during COVID, it's pretty predictable that at some point prices make things so discounted that people say, I have to take a shot. Case in point, we did in our notes from Jazz, we talked about Michael Jordan's house. The poor guy can't sell his house, been up for sale for a decade. But truthfully, if the price came down $1 million, there might be a little interest. If it came down another $1 million, if it came down $5 million, you see at some point, if Michael Jordan's house in Chicago, not the best location, but if it's there, if all of a sudden it's for sale for $1 million, the demand would be so huge, it would sell in minutes, right? So the market does the same thing. The S&P can get so extremely oversold where people say, that's a deal, I have to do it. I don't care if it's the bottom, that's good enough for me, right? Same thing on the way up. So if we go back here to the S&P, you had that moment in time. You had an sort of an extreme, but you also had a location where people could say, I don't want to bet that it breaks this downtrend here, given the fact that it could not do it here, it could not do it here, could not do it here or here, right? So people will say, I'm going to wait. I'm going to sit back. It may turn around tomorrow, start rocketing higher and break that downtrend. That's where people want to buy, or I would assume most of you would want to buy. So your odds of buying today are purely just a guesstimate, right? Okay, maybe it goes up, maybe it continues lower. I just don't know. So people now will say, let me wait for the market to pull back, consolidate, maybe get forward towards that February 1st Fed meeting and see if we get our catalyst that helps move us higher or helps us fall apart. And so if you're looking at investing or buying something in some significant amount, no. I mean, I can't tell you, but I would say, really? Out of all the times, like this is the moment? I would probably sit back. All right, moving on. You got earnings season now fully underway here, right? I told you there's a bit of a catch for this earnings season, and I hope this is not becoming more common. I thought it was, so I put together a little chart. Maybe it is, maybe it's not. You can analyze this yourself here, but be careful on looking at stocks and saying, I would like to buy that stock because I have a good feeling that they have earned more. Their profit margins are larger. They had more sales. They're growing. Because that company may have already told us that. So they call it pre-announcing. And right now, this is the second most company ever, the second most amount of names in the S&P that have pre-announced their earnings and just basically told you what it was going to be like. So take a look at this. We have 21% of the S&P so far that has pre-announced their earnings. We already know what it's going to come out as. So on earnings day, it's just going to be like, well, we know the numbers, so what is your guidance? What are your forward projections? What are you estimating that things happen going forward? That's what's going to move the stock. So if you're looking at an individual stock and trying to determine whether you want to buy it, it's probably the fact they've already pre-announced. You're going to look at how they guide going forward. Hey, we're going to lay off a bunch of people, and that'll help us, that'll help our bottom line. Hey, we're going to launch a new product, and even if it kind of sells, that means we're going to make a little bit more money. Hey, we saved some money by buying a whole bunch of our materials in bulk, which means we got a lower price compared to what it is now, especially if it's eggs, and therefore, we're going to have a bigger profit margin. That's what people are going to look for earnings. The chart that I'm showing you here is in fact 21% compared to last quarter, the quarter before, the quarter before, quarter before, and so on and so on. During COVID, now, I'll give you this one. This is kind of an outlier. A lot of people said, we're not even really sure how to project going forward, but we know our numbers now, and so here you go. We're going to pre-announce our earnings. That's the highest it's ever been. This is a record. And by the way, we're trending higher. So is it becoming a theme in the S&P to pre-announce your earnings? Allstate would be the latest to actually do that there. All right, so what's going to drive the majority of this earnings season is going to be forward. You might hear forward revisions, forward expectations, guidance. That's basically all saying the same thing there. So something you might want to check out, just saying. What else do I have for you here? I mentioned wine and wealth already. We don't have to do that anymore. Let's do some stocks in the news. And let's do it correctly. There we go. All right, Discover Financial. This is earnings, right? They reported their earnings there. Discover Financial beats on earnings, beats on revenue. They were one that pre-announced. So without even looking at it, I don't know what they talked about there. They had some concerns about the general financial health of the consumer. Of course, that plays into them. Will people pay their credit card bills or not? And so that's partly what we're looking for. Oh, charge-offs. That was not pre-announced there. Charge-offs a little more than expected there. So that explains the volatility here for today on Discover Financial and probably affecting some of the other names as well. Yeah, let's go over here. Fastenal. Okay, Fastenal, not one that had pre-reported. No, not one that had pre-reported there. Better than expected earnings, raised their dividend, by the way, which is good news. Usually makes the stock a little bit lower on the day they announce that, but good news overall. Dividend going up, looks like 43 cents. Not bad for them. What else do we have here? Oh, speaking of dividends, Vornado, very popular REIT, right? And I'm just going to go real quick and see what it was. So they change their dividend, and not in a good way. This is a potential tip of the iceberg for some of these. People tend to get excited about these REITs because of their dividend. Yeah, it was 9.56% total yield. Now the price is lower, but they pay $2.12 overall. They're going to have to lower their dividend. In fact, they actually already announced that they're lowering their dividend there. They dropped it 30%, down to 37 cents a share. So from 53 down to 37.5 cents a share. Why is that? I was curious, so I looked. They call them concessions, right? Wall Street can never use just a simpleton type word. No, they call them concessions. Remember, REITs, not necessarily these guys in particular, but REITs in general, how do they make their money? Buying something that can generate rent that offsets the cost of whatever it is that you're renting or they're offering. So rent prices skyrocketed. And I thought, have they gone down? Have they been going down? Is that what's going on out there? So I looked to see, and in fact, the way you tell that is by looking at the number of concessions that they have to offer. So this is definitely a trend that's going to continue here. The percent of apartment companies out there that are having to offer concessions by month. So we'll pick our area. Where are we at here? Tampa. So in January of last year, only 2.3% of apartment companies were offering some kind of concession that ultimately results in a monetary give to the person to incite them to come rent our apartment, right? Not very much, right? Rent prices sky high, everybody's freaking out. It was worse in February. What's happening now? Look at this trend. More and more, we're having to do things. We're trying not to lower the rent, but we're having to do things like that first month free, or maybe 30 days at the end of the month free, or whatever it is, right? They're having to do things. 21% of all apartment companies that are public, that have properties here in the Tampa area, have had to give concessions. Phoenix, 27%. It was 8% last year. So I did this just to show this is pretty extreme. San Francisco would be the extreme out of the list. 20% at January of last year, almost getting to half there. So if you're renting in San Francisco, turns out you might want to be asking for some concessions. What type of concessions do you have there? Maybe you let me move in or something, right? Now, there's a lot of things that play into what causes this, but what I wanted to point out at the moment was that explains why someone like Vornado, even though their focus is really on like Manhattan and like sort of prime projects there, more office space, retail store facing type stuff. They do have some residential buildings, but it's not a large part of their portfolio. Still affecting them as well. They're not able to get those high rents that they wanted, or we should say it as rent prices went parabolic. They can't continue that way forever. So very interesting way to see that there. What else do we have? Just a couple others earnings-wise. Got Procter & Gamble. So Procter & Gamble earnings basically as expected. Yeah, I don't know why it went lower today. To be honest, this one, I don't generally get too excited to look at Procter & Gamble. And Netflix is the big one. I'm losing this thing here. Netflix after the close here. Anybody got some news on that one while I get stuck trying to type this thing? There it goes. It's just a little delay. It's not quite ready to get going yet. Netflix up a couple bucks. Keep in mind that wherever it lands, the fourth quarter earnings report, which is what this is. I've done this before. We've covered this chart, and I was all fancy and everything. Fourth quarter earnings for Netflix is by far their best. So they beat on earnings 90% of the time, revenue 70% of the time. The average gap up is the only quarter for them that's positive. So you would expect, statistically, for this to hold a positive gain and open positive tomorrow. It looks that way going forward. Just kind of breezing through here to see. Streaming, new additions, 7.6 million. Okay, yeah, not bad. So this will go down, at least on the surface here, this will go down right in there, right as even though their earnings fell there. Total revenue's higher. This goes down as one that we would consider a beat. Yeah, higher subscribers and everything. Very cool. And that's what I have for you. Remember, Wine and Wealth here a little bit later. Looking forward to it, getting back in the seat. Eric last week helped you with some things to consider in the new year. Tonight, I'm going to be going through Secure Act 2.0 strategies now that we've had time to digest it. figure out what in the world is going on with all these laws they're putting out there and stuff. Yeah. I'm back. Chief of Dough is here, man. Chief of Dough is here. I love it. Chris says, don't take it seriously. Uh-oh. I won't look back and see what you said then. 275 or 245 for gas last week, then jumped 265, 298, 309, 319, less than 2 weeks. I was going to say that. Not gas, but, you know, I bought some chips last night. You know, they weren't on sale. I like chips. And $5.19. I'm not going to say I'm like someone that shops for chips often, but it just seemed a little high to me. That caught my attention. I almost didn't buy them. As the more I looked around, I'm like, is this like a new round of inflation? I don't remember that being the case. Yeah. Interest rates are also hard, but keep in mind, you know, generally the longer term rates have pretty much pulled back. Not to where they were, but still. Hey, if you draw a trend line from the low through the higher end of the low, the meeting, the downtrend line, where the chances you're going to trade inside that wedge until February meeting. Oh, for the market? I mean, that could be what we're doing. You only got 10 days, 10 days left to go. Yeah, it could be the case. Is the class tonight open to research members? Is it? It's up to me? I get to decide about that. Well, yeah, sure. Let's do it. So yes, if you are a research member and you want to join, jazzwealth.com/research, but the class tonight, we'll make it to where you can see it as well. And all you got to do is bring a glass of wine. Come hang out with me. Yep. I think gold is over bought in the short term, but that's interesting. You got to rally. When gold rallies, that's kind of like oil. It's going to go, right? So I wouldn't chase it. But now you look at that and say, okay, hey, gold was quiet for a while. Everybody was doing this Bitcoin thing. Now that I can't do that, I go over here, I protect my money with gold. Okay, no problem. I don't want to chase, but now we're awake. Goes on a watch list for sure. Price gouging on chips? Oh, I don't know. I saw the thing about eggs. I don't know. I haven't followed up with that, but that's like all over the internet with these people with their eggs. I don't know. That's a funny one there. All right, I'm going to get ready for our class here tonight. From what I hear, though, $6 is a bit of a bargain, right? From what people are saying. Don't know. I'm going to get ready for our class here tonight. I appreciate you guys hanging out with us. Hopefully you learned something today. Give you a little extra value for your time. And in exchange, there's that subscribe button. Make us look a little bigger than we really are. Maybe people will pay attention, you know. People in my industry, honestly, they know us, but they could care less, right? I'd like to change that a little bit. Anyways, enjoy the rest of your day, and we'll see you later on a closing beat, or not a closing beat, the Wine and Wealth class. Coming? All right, see you there.